What's going on? Ryan here. In this video, we're talking about the Long Call Condor. Now, again, I have Apple here loaded up. And just to talk about what we did before, remember, in the previous videos, we talked about this iron condor being made up of a call credit spread and a put credit spread, right, above and below the market. And again, the iron condor being the call credit spread and the put credit spread, with the short middle strikes being the same strike, right? And now we're going to look at another strategy, which is also an iron condor, but that is made up of only calls, right? So what does this actually look like? Well, the way that we do this is it's a combination of the call credit spread as well as a call debit spread, right? So for example, we could sell this 180 call, we could buy this 185 call, and then below this, for instance, we could sell this 170, call, and then we'll buy this 165 call. And again, this when we change from the iron condor and the iron butterfly into the long call condor, and in the next video, the long put condor, these change from debits to credits, right? So on this 5-point spread here, we're risking half of the spread as a debit, right? So we're risking 250 to make 250, right? It's a 5-point spread, and we're risking half of that spread. And again, when we put this trade on, it's going to look very similar to the iron condor, right? Where we will make money on this just from the passage of time, right? Where our risk is 250, our potential profit is 250. And again, as time goes forward, if the market doesn't move, then we can capture this theta decay and we can make money with this. Now, important to understand that when you're using the long call condor, right, we're putting together the call credit spread with the call debit spread, right, where above the market we're selling the strike closer to the money, then we're buying the call above it as insurance, and then we're actually, if we're doing this to have the actual asset lie inside of this condor, we would then be putting on a call debit spread that's in the money, right? Another way to look at this is if we thought this was going to fall, right, we could actually, if we thought that this was going to go down to 160, you could actually do a trade where, okay, we sell this 170, right, we buy the 170 in the money, and we think it's going down to 160, so maybe we sell the 155 and we buy that 150. And again, this is a debit, but now on this debit, right, if we could get this for 175, this is much better risk to reward, right? And that has to do because we're doing this in the money, right? So 175, again, 5-point spread, we're risking 175 to make 325. And because we're doing this in the money though, right, this actually is going to look a little different, where we can use this long call condor to actually create a bearish trade, right? We're putting this on, and it's only going to make money when Apple trades down in between these wings. And again, the theta is decaying away, and now we're making money, and we could close this out. So remember, there's lots of variations of these, of the iron condor, right? The iron condor, the iron butterfly, right? Those are done for credits, as opposed to the long call condor, which is done for a debit. Okay, so again, if you have any questions on this, feel free to reach out. If you want to jump on a one-on-one coaching session, I would love to, spend some one-on-one time with you and help you with where you're getting stuck, or maybe some ideas, or how this applies specifically to your situation, right? Again, this isn't trading advice. It's not investment advice. I don't know your situation. I don't know what your goals are, right? Everybody's different. Everybody's financial situation is different. Everybody's goals are different. So it's important to understand that. But again, one-on-one coaching, especially when it comes to options trading, can be an invaluable tool, right? I mean, a lot of people out there have Discord channels, right? Trading channels. And at this time, I'm not offering a service like that because it's not where I want to focus my time, because my own personal goals and what I'm trying to accomplish are different than other people's, right? So I don't want to just be giving signals away. It's not what I'm interested in. But again, I'm always happy to answer questions, and I like helping people one-on-one, because I think that's where people learn the most, right? And obviously that, and trading in the market. Of course, I suggest that you paper trade just to understand these mechanics and how we input these, and understanding the risk and what it looks like, and to give you confidence. But nothing is going to prepare you or give you more experience than actually trading real money in the market, because then you can see how sensitive options are and the way that they move relative to the way the underlying assets move. Right? You're also going to need to train yourself emotionally to deal with volatility and different situations that arise in the market. And again, with all of these condors, with all of these spreads, right? If we look back at, for instance, this iron condor, right, that we talked about previously, the risk here is always if the underlying asset is going to settle between these strikes, right? Just like we talked about the credit spreads and the debit spreads, where the risk is always when the asset settles in between your strikes at expiration. That can cause problems depending on how much leverage you're using. So again, with these condors and these butterflies, some people like to trade these 0 days till expiration, right? And you can make money doing that. But when you don't have a lot of experience, or you're first starting to trade, it's much better to either buy these spreads that are debits with more time, or to sell these spreads with more time, so that you're not putting yourself in a position where you don't have enough time or wiggle room to make adjustments. I think that when you're first learning, you should always buy more time or sell more time, just so you can protect yourself and not get yourself into trouble, right? Because at the end of the day, we never want to let these settle in between the strikes of the wings, because we don't want to face that assignment risk and what that could mean if the underlying asset makes a volatile move after we've been assigned, right? That's like the worst thing that can happen. And if you haven't seen this already, if you go on to Wall Street Bets or some of these trading forums, right, there will be people who have experienced this firsthand, where they did a trade with limited risk, right, where they only thought they could lose a small amount of money, right? and they weren't paying attention, and now the spread settles between the strikes of the wing, and they're assigned a whole bunch of shares, short or long, where they have lots of leverage, and now the market opens up the next day, gaps down, gaps up, whatever it may be, and now they've lost a lot of money because of the assignment risk and the leverage. And it's just a silly way to lose money, right? It's not necessary. It's not necessary if you plan and anticipate that is a possible scenario where all of the risk is going to occur, right? So, as an example, if you're in a scenario where one of the wings is being challenged, right, you can always, roll down and out more time, or you could just close it out for a small loss and open up a new spread, take in a credit to offset that loss, right? And that's the great thing about options, right? Is we have all of these options to make adjustments, to get out of the position altogether. And that's what, being an investor is all about, is making those decisions when they come, the difficult decisions, right? A lot of people, it's hard for them to take profits when necessary. People tend to hold on to these losing trades. They get emotionally attached, right? They want to be right. You don't need to be right all the time, right? That's the glory of these options, is that we can put these spreads on. We don't need to be 100% right. We can still make money. But at the end of the day, to make money, to make these great decisions, we need to be disciplined, right? Disciplined in getting rid of losing trades, disciplined in taking profits when we have winning trades. And that is really what it comes down to, right? Is having all of these tools, knowing how they work, knowing when to use them, and then being able to have the discipline in ourselves to make these high quality decisions. Okay, so again, if you have any questions, feel free to reach out. I, again, highly suggest either one-on-one coaching or mentorship. If you're interested in something like that, please reach out to me. I would love to help you on your journey. So again, just to recap, in this video, we talked about the iron butterfly, the iron condor, right, being credit spreads, and now we've introduced the long call condor that roughly looks the same, right? That we can actually put above or below the market for a bullish trade. But remember, the long call condor is always done as a debit. So again, if you have any questions, feel free to reach out, and I will see you in the next video.